Billions of dollars in AI-powered money bots just got slapped by Washington, and entire sectors of the market lost over $10 billion in value in a single trading day. If you own an index fund, a robo-advisor account, or you care about the 2026 elections, this hits you directly. I'm Thomas Paul. This is the comment section, and tonight we're breaking down why DC suddenly woke up, pointed at Wall Street's AI tools and political bots, and basically said, yeah, about that. Here's where things get interesting. Over the last 24 hours, regulators in DC didn't just float an idea. They fired a warning shot at the core of AI finance. The SEC, backed up by noise from the CFTC and key committee chairs on the Hill, signaled new rules and enforcement around AI-driven trading, robo-advisors, and automated political fundraising. One senior official basically said in polite regulator speak, if your AI can move markets or elections, expect to explain yourself under oath. Markets treated it like a real threat, not a think piece. A leading AI fintech that markets itself as machine learning for everyday investors dropped close to 11% intraday. That's billions in market cap erased before lunch. Several AI-heavy trading firms sold off 5 to 8% in sympathy. Why such a violent reaction? Because AI isn't a side project anymore. By some estimates, strategies using AI now touch trillions of dollars in assets and drive a huge chunk of daily trading volume. You don't tug on a thread that big without shaking the whole sweater, but it's even getting worse. This isn't happening in a political vacuum. It's 2026. Every move in DC right now is about power, money, and narratives. On one side, you've got Democrats framing AI as both a systemic financial risk and an election risk. The talking point is, unregulated AI can crash markets in seconds and flood voters with hyper-targeted political manipulation. So they're pushing for tighter controls on AI trading models and automated campaign tools, including rules that would force campaigns to disclose and audit their AI ad engines. On the other side, Republicans are accusing regulators of choking innovation and protecting incumbents. Their line is, you're helping the big old banks by kneecapping the new AI players. Several lawmakers have already used the word overreach more times than I heard synergy back when I was stuck in corporate. And here's where things take a step further. Behind the speeches, look at who's lobbying. Legacy banks and big brokerages are quietly okay with rules that slow down aggressive AI startups. They can afford compliance teams. The little guys can't. Meanwhile, big tech and AI labs are flooding hearings with white papers about responsible innovation, which usually translates to don't ban our stuff right before the election. We've got bills on the table to classify certain AI trading systems as systemically important, to force registration of AI political ad tools, and to give regulators more power to demand the code or training data behind high-risk models. That's not just talk, that's a new power grab. But then the unbelievable thing happened. Wall Street instantly voted with its feet. That AI fintech I mentioned? An 11% drop is the market saying, we don't know what Washington will do, but we know it'll be expensive. Another large robo-advisor that leans heavily on AI portfolio optimization lost around 7%, wiping out several billion in combined value between them. At the same time, big diversified banks nudged higher. Compliance software vendors? They actually rallied. Investors are already betting that if AI gets wrapped in red tape, the folks selling the tape are going to do just fine. Let's make that concrete. Imagine a $30 billion AI trading shop facing new model audits, explainability rules, and liability if its bot moves a stock based on bad data. Even a 5% drop is $1.5 billion gone in hours. All because someone in D.C. gave a speech and hinted at enforcement. Second-order effects are already being priced in. Campaign tech companies that build AI tools for fundraising emails and micro-targeted ads are suddenly at risk of partial bans or strict caps. That means campaigns shift money back to more traditional channels, TV ads, big media buys, and yes, old-school human consultants. So into 2026, if AI tools face caps or audits, you could see more money going to big media platforms and fewer viral, hyper-tailored AI campaigns, at least from the regulated side. But then he said this unbelievable thing. A senior lawmaker basically admitted in an interview that if they don't clamp down now, AI could decide which messages voters even see. That's not a technical argument. That's fear of losing message control. Now here's the problem none of these people want to talk about. Markets and politics are very good at routing around obstacles. We've seen this movie. When regulators tightened certain derivatives rules, trading just moved offshore into less transparent jurisdictions. When countries tried to ban specific crypto exchanges, volume shifted to decentralized platforms and anonymous wallets. The activity didn't vanish. It just got harder to see. Expect the same pattern here. If you make it insanely painful for a U.S.-registered broker to run an AI trading model, some of that innovation will move to a London or Singapore entity, or into a DAO living on a blockchain with a shrug emoji for a legal address. For political money, if AI fundraising tools on mainstream platforms get heavily audited, campaigns and super PACs can push operations to friendly nonprofits, foreign-based vendors, or independent data shops that sit just outside the tightest rules. The voters will still get hit with tailored messages. They'll just be less regulated and less transparent. Here's where things get interesting. So what do you actually do with all this if you're a regular investor or just politically awake? First, watch the calendar, not just the headlines. Key dates matter. Comment periods on proposed rules, scheduled hearings on AI systemic risk, and deadlines for election tech regulations. Markets often move when drafts drop or when a committee chair signals which version of a bill is alive. Second, understand exposure. Companies that literally market themselves as AI-first trading, pure-play robo-advisors, and small fintechs built around political data and campaign tools are most at risk. Broad index funds are not immune, but they're less likely to get wrecked by a single enforcement action. Third, separate real systemic risk from pure theater. There are genuine concerns here. Algorithms that can trigger flash crashes, models trained on biased or fake data, campaign tools that can deepfake their way into voters' brains. But there's also a lot of "look how tough I am on AI" for the cameras. Quick disclaimer. Nothing in this video is financial advice or legal advice. It's information and opinion to help you think more clearly. Do your own research and talk to a licensed professional before you move money, but it's even getting worse. While we're talking about AI doing all the work, quick note. This entire episode was created using Fludge.io, the same system that powers this channel. If you're watching and thinking, "I'd love to run a YouTube channel like this, but I don't want to be on camera," that's literally what it's built for. Fludge researches topics, writes the script, builds the thumbnail, pairs everything with an AI avatar, and uploads to YouTube. You stay in control the whole time. You can step into research to write or even record your own video and let it handle the rest. Over time, it learns your style and gets better. This isn't low-effort AI spam. If it were, you wouldn't still be here. It works across niches: finance, news, history, hobbies, whatever you're into. If you want to start a channel without burning out, check out Fludge.io. Link is in the description. And here's where things take a step further. Let me end on this. When I was about 12, my parents lost most of their savings because a bank advisor told them very confidently that a certain product was safe. No scandal, no headlines, just a quiet dinner table for a long time. That's when I learned experts can be dead wrong, and the real pain shows up long after the press conference. Now fast forward. Washington let AI snake its way into trillions of dollars in assets and into the bloodstream of campaign spending. Only now, with the 2026 election looming, they're acting shocked that AI might be a problem. Both parties have happily taken AI-linked donations, hugged tech donors on stage, and used every digital trick available, while warning us in front of microphones about the danger of AI. So here's my question for you, and I really want answers in the comments so we can build a follow-up episode around them. Going forward, who do you trust more to manage this technology? Regulators in DC or markets and investors forced to live with the consequences? Drop your take below, especially if you think there's a third option I'm missing. If you found this breakdown useful, hit like, Subscribe to the comments section with Thomas Paul and share this with one friend who still thinks AI finance is just a tech story. It's not. It's about power, money, and your future.